Okay, the next problem that we're working on in chapter 3 is E312. E312 is one of those problems, again, that has a lot of information, so I've written some of it on the board to try to help us save some time, but we'll go over it. One of the main things that I've written down that'll kind of be a little bit time consuming is writing out the T accounts, okay? The first requirement in this problem, E312, it gives you some information about Ricky's Piano Rebuilding Company. And the first requirement asks you to create T accounts for several different accounts, both the ones where they give you beginning balances and the ones where they don't give you beginning balances. So I've listed out all the T accounts here. We'll talk about posting the journal entries to those T accounts a little bit later, but your first requirement is to simply list out the T account. Remember, a T account, it's called a T account because it looks like a T. In this example, you have a capital T right over there, okay? The first thing that you would do is enter in whatever beginning balance that you have, and then as transactions take place, so as we do journal entries over here, you will write those journal entries in the proper T account. If you're debiting it, right, it's going to go on the left-hand side. So for instance, I just pointed to accounts payable. If we're debiting accounts payable here, it's going to go on the left-hand side. That's a debit, okay? And if we're crediting, let's find a credit to accounts payable. We get a credit to accounts payable right here. It's going to go on the right-hand side, okay? Notice that there's references to each one of the numbers. Here we have the letter H. We can go back to H, back to the transaction number H, and see that that's where we actually debited accounts payable. Here we've got the reference F, so we can go back to transaction F and then find the accounts payable journal entry that we made, okay? So we'll get into this in a little bit, but your first requirement is create T accounts for all the accounts. So notice that we have listed out here each individual account, okay? I've had in the past students, when they're trying to understand T accounts, they might get confused and fill out one T account for all accounts or something like that. I've had others in the past where they can create a different T account for every single transaction. For instance, in here, we've got several transactions in cash, and I've had students in the past create an individual T account for each and every transaction, and that's not what you want to do. What you want to do is create an individual T account for each account. So one for cash, one for accounts receivable, one for supplies, and then you list out the transactions that took place for those T accounts, starting with the beginning balances that they give you. Okay, so let's work through some of the journal entries that they give us. Again, I've written out some of those as well, but we'll do the first four together here. So on A, it says received a $500 deposit from a customer who wanted her piano rebuilt in February. Okay, we received a $500 deposit here, so we've got cash. We know that because we've been paid cash. So put 0.5 there. Now, if we received a deposit to be built in February, that's when we're going to rebuild the piano, and we're dealing with the month of January 2013. Have we earned the revenue yet? No. So we want unearned revenue, okay, unearned revenue 0.5, okay, and now we balance. Don't forget, unearned revenue is what type of account? A liability account. It is not revenue, it's a liability account. All right, next. It tells us that we rented a part of the building to a bicycle repair shop. $300 rent was received in January. Okay, in this instance, we received cash. This tells us, I think it was 300. Yeah, we received 300, okay? And then we've also earned revenue. Remember, we've got rent revenue here for the month of January. It tells us in the problem that this bicycle repair shop paid rent for January. And notice that our company, our rebuilding piano company, is receiving the rent. So that's revenue to us. We're actually renting out part of our shop to another company, okay? So we're getting revenue for that. So credit rent revenue, that increases revenue. On the next one, it says we delivered 5 rebuilt pianos to customers who paid $14,500 in cash. Okay, again, we've got cash, so we're going to debit cash here, $14,500. Okay, and then we actually earned revenue. Why did we earn revenue? It tells us that we delivered 5 rebuilt pianos. So we actually provided the service, we delivered those pianos, so we earned revenue here. And you can call that rebuilding revenue. Let's see what type of revenue. It's a service revenue. Let's call it service revenue here because we're actually providing a service of rebuilding the piano. So let's call it service revenue. And we'll do 14.5, okay? All right, next, it says that we delivered 2 rebuilt pianos to customers for $7,000 and charged that on account. So we again delivered our pianos. So we did our service. We provided our service. So we earned our revenue. But it says that the customers charged on account. When they charge on account, that indicates we've got an accounts receivable. Why? We have the right to receive cash. Why do we have the right to receive cash? Because we provided a service. So we have accounts receivable, and we'll credit service revenue to stay consistent here. The other thing is the reason why we know it's service revenue is they give us the T accounts that they want us to create. And the only revenue accounts that we have is either rent revenue or service revenue. So we'll be booking this to service revenue. And the amount that we've been given here is $7,000 on account. So $7,000 here and $7,000 here. Okay? All right, the rest of the journal entries I've written up here, let's go over them quickly. It says we received $6,000 from customers as payment on their accounts. So other customers have now settled their account, they paid us money. So obviously if we're getting money, we're debiting cash, okay? And we're reducing accounts receivable. Why? Because they no longer owe us the money. Why? Because they've given us the money. So we're reducing accounts receivable. We reduce accounts receivable, which is an asset, with a credit. Remember, debits are on the left, credits are on the right. Assets are on the left side of the equation. Liabilities and stockholders' equity is on the right side of the equation. Okay, next it says we received an electric and gas utility bill for $350 for January services to be paid in February. Okay, we haven't yet paid the bill, so there's no credit of cash because we haven't paid cash out, but we owe it now. Why? Because we received our services in January. Even though we're going to pay it in February, we received our services in January. So we debit utility expense because we've incurred an expense. We were provided our services. And we credit accounts payable because we have not yet paid the cash, but we owe it. So we credit accounts payable. All right, next is G. G says we ordered supplies of $800. Okay, if we ordered something, do we necessarily have a transaction? No. There was no exchange given. Nothing was provided by either provider. Neither the people that we ordered the supplies for, nor us giving cash for the supplies, right? So we have no actual transaction, so there's no journal entry recorded. Next one. For H, it says we paid $1,700 on account in January. Okay, so when we see this phrase, we paid on account, what that is indicating, okay, we've paid down our accounts payable. Notice over here, we've credited some accounts payable. I believe the first one, I guess, was up here on letter F. We've credited accounts payable. We also started with a beginning balance over here of accounts payable for $8,000. Okay, so we paid off some of our accounts payable. We'll reduce accounts payable by debiting it, and we'll credit cash because we're using cash to pay off the account. All right, the next one says we paid $10,000 in wages to employees in January for work done this month. Okay, work done this month means we incurred an expense. Remember, we're dealing with January 2013. So we'll debit wage expense for the amount that we've incurred, and we'll credit cash, not wages payable, because we actually paid them this month. The next one says that we received and paid cash for supplies in G. So in G, we didn't have a journal entry. Why? Because there was no actual transaction that took place. But now we've paid for the supplies and we've received the supplies that we ordered in G. So we'll debit supplies because supplies is an asset, right? You stick some supplies in your closet, Post-its, paper, whatever. Stick those in the closet or warehouse or whatever you have. Debit assets because you have those on hand. So we have supplies, increase in an asset account. And we'll credit cash because we've paid for those supplies now, so we'll decrease cash. Once you get all of your journal entries created here, once you've created all your journal entries, you'll then take the amounts and post them to the T account. So you can see here in cash is quite filled up. There was a lot of different instances when we've actually used the cash account here. The best way to do this, after you've got all your beginning balances listed out here, so beginning balance, beginning balance, beginning balance, and those were all given to you in the problem, scroll through your journal entries and say what accounts are affected. If we start with the first one we have listed here, cash, okay? We'll look here, we've got cash, 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 cash. We'll start posting all the debits to the cash account, and we'll make reference by the letters for each one of the transactions that we had, okay? Then we look for any credits to the cash account and post any of those that we find. And we go through that process for each one of the accounts until we get all of the transactions posted, okay? Notice that some of these, they have no actual transaction for the information that we were given, no actual transaction that we need to post, but we still have a beginning balance, so we have to carry forward that beginning balance. Because in the next problem that we look at, I believe the problem is E313, we're going to use this information in the T accounts to then create a trial balance. And the trial balance is the next step before you create your financial statements, okay? All right, look this over, take a little bit of time, make sure that you understand the T accounts, make sure you understand the journal entries we have here, and please send me any questions that you might have. Thanks.